How's it, guys, and welcome back to Paradigm Flip. Hope you guys are doing well, and I haven't posted in quite a while, and the reason being is that here in South Africa we've been experiencing a lot of load shedding, and basically what's been happening is that if you stay in South Africa, you'd know that the government has been taking electricity quite frequently, and because of that, I really haven't been able to sit down and actually make a video. Beyond being busy, whenever I get some free time to actually make a video, there's no electricity. So that's basically been what's happening with me. But right now, I do have electricity, and I'm going to take advantage of it and make a video for you guys. And today, basically, I'm talking about Fibonacci, and I'm not going to waste any time. I'm going to make this video as short and to the point as possible. And let's get straight into it. So on the screen, what you can see is two Fibonacci retracement tools, right? I got a modified one right over here, which is my one, and basically a Fibonacci with standard settings, right? So this is basically what a lot of traders will be using, right? When they draw up any standard Fibonacci tool over the chart, right? And I want to get into why we shouldn't be using this tool, and we'll get into explaining why the way I use my Fibonacci tool is more advantageous. Okay, so firstly, if we just focus on our right here, right, we'll notice that we have our standard Fibonacci tool, and basically what this tool has is we have our standard levels. So you obviously have the 23% retracement, the 38% retracement, the 50% retracement, the 61.8% retracement, and the 78% retracement. And normally as a target, what you'll see is 0.618. Okay, and basically what this tool is used for, right, is to measure the percentage of a retracement of a move, right? So usually when we get a simple impulse, right, and we begin to get a pullback, right, we draw our fib tool from the swing low. So this could be any swing low. We draw our fib tool from the swing low to the swing high, and we begin to monitor this pullback, right? And the basic idea is that we are looking for rejection, right, of any of these levels, right? Now, this is the main problem with Fibonacci, is that we could experience rejection at every level. So you could get a rejection of this level, and price could trade lower to the next level, okay, and so on and so forth. So how many times do you expect to take a trade before realizing that the market has now traded below the previous low, and you were waiting for one of these levels to reject, right? And ultimately that didn't happen. So you'd obviously be expecting a continuation trade. Okay, so you'd be expecting any of these levels to reject, right, and continue moving up towards your target. Okay, if we are looking at a simple price fractal. And how many times are you going to actually wait for any of these levels to reject, right, up until price is all the way down here? Perhaps maybe we had a rejection, in fact, a strong rejection, right, of one level, and then ultimately trades to another level, we reject, right, and maybe perhaps you take another entry, okay, and ultimately we trade lower to another level, okay. At what point do you stop trying to buy this dropping market, right? And that's initially the basic idea why we have a problem, right, with the traditional Fibonacci, right? So this is no good, okay, and we want to move to a better approach, and that's what I'm here to explain to you guys today. Okay, so I'm just going to remove this off my chart, right? And basically we want to focus on this tool right here with these settings. Okay, now with my Fibonacci tool and the way I use it, what you'll notice is that firstly my values are different. So I keep the 0, the 50% retracement, and the 100% retracement. And as my targets, I have the negative 50 and the negative 100. And you'll notice everything is equally spaced, which is also very important. Okay. Now, the way I use Fibonacci is more so to gauge the order flow. So I use this to tell me a story of price and to give me an idea into the mind of a crowd of traders, right, at any price point. And this is a more effective way of thinking about it, right? And you'll see why that is in a bit. Now, obviously, the idea is still the same. So I am looking for a impulse, right? And I'm looking for some sort of pullback. But I'm not trying to monitor, right, at which level. Okay. Remember, on the traditional Fibonacci, we have a whole lot of levels. I'm not trying to monitor which level we're going to reject off of. Okay. What I'm trying to do is I'm trying to gauge the order flow, right, of the price move that's occurring at the current moment. Now, one thing you need to understand is that whenever we have a swing point in the market, right, you must know that there are buyers and sellers at that price, okay, at those areas. Now, it also should be known that institutions or large funds that actually can drive price will not have all their position size in one location. So what do I mean? I mean that at a turning point or any turning point in the marketplace, right, we are not going to have one line where the institution enters all their trade. Okay, they are using a lot of money, right, and they need to fill their position, right. So if they are looking to buy, they will need to buy as price is coming down, right. So they need to average into their position, right, and then take advantage of whatever move happens right after that. Okay, so they actually need to average into a zone of price. Okay, so they will be entering in a large area, right? As tight as possible, obviously, but it's not one thin line. And same thing if they want to sell, right? They need to start selling before price turns, right? So they average into that move, and that essentially is what slows down price, and that's why you usually get a lethargic move up, right? That is basically accumulation of shorts. Okay, and basically what's happening there is that they're averaging into the move. Now, this always obviously doesn't occur, but that's the basic idea behind it. Okay, it's either you'll see that or you'll basically see a lot of candles getting smaller, right? So we have large range candles to begin with, and they begin to get smaller and smaller, right? And oftentimes you'll also see one large push up and a sharp reversal, right, as a trap. Okay, now essentially that's basically what's happening, right? This large move will attract a lot of buyers and they can sell into that. Okay, and they can get a lot of their position in a very tight area. Okay, so we need to understand that concept because when we get a swing high and a swing low and we can draw our fib over it, right? Whoever is shorting up here or within this band of price, right? Within this area here, okay? However wide it may be, right? When we break below this 50 line, anyone shorting in this area here is making money, okay? And anyone who was buying in this area here, right, is now under pressure. Okay, so this is an important concept because if these guys give up their positions, right, if these guys have to capitulate, they have to sell all their buy positions, and that's going to drive price lower, right? So that's the basic idea, right, of the 50%, right? It's basically the line in the sand between buyers and sellers, and if price is above the 50%, right, in this area, we know that buyers are in control, and below the 50%, sellers are basically in control, right? So when we get our impulse, right, and we wait for our pullback, we basically want to see price above this area, right? We're not looking for a specific price of rejection. We're not looking for a 618 or a 318 pullback, right? It doesn't have to be shallow, right? We can come a bit deeper. We're not looking for anything specific in here for price to reject off of, right? The only thing we want to see is that price is holding above the 50. Now, if price trades below the 50, right, we do not want to trade. Okay, what we want to see is we want to see price rejecting the 50 level. And once we see this, this lets us know that buyers are coming in, right, at these levels to defend their positions, or we have buyers at higher prices. Okay. And what we do not want to see is price trading below this level and starting to consolidate, because this lets us know that we now have sellers at lower prices and sellers are now defending their positions up here, right? And if the sellers are in control, right, and we see them coming in at lower prices, these buyers are basically most likely going to capitulate, okay? And all these buyers, right, will have to exit their position, right? Because every time they try and buy more, right, we got more sellers coming in, right, and more sellers coming in, right, taking the other side of their position, right? And that's basically going to let them know to say that they cannot push price higher and they don't want to end up with price all the way down here or much lower, right? They'll be very upside down in a losing position. So they're going to have to capitulate or exit their positions, right? And that buying, right, is going to turn into selling, right? And that's going to drive price lower. Okay. So when we are below the 50, right, we do not want to trade. We want to see that rejection, right? We want to see that rejection of the 50 level and we want to see price holding above this area because this lets us know, right? Once we get this rejection, it basically lets us know that we have no sellers at lower prices. And once we get this rejection, we want to see it holding because this lets us know we have buyers at higher prices. Okay. And any selling in this area is now losing money and they basically are most likely going to capitulate and we are most probably going to see a continuation. Now, there are obviously times where we could get a very deep pullback, right? Beyond the 50, which is fine. But as long as we reject that area and hold above the 50 area, right, we will be expecting higher prices to target the high and other target prices. Okay. And obviously, there are instances whereby we do not retrace to the 50, right? So we basically get a very shallow pullback, okay, which is fine. And what you'd be looking for, especially if you get an ABC, right, or a consolidation, you're going to be wanting to look for a break of that consolidation and a rejection of that point, and that lets us know that we are rejecting, right? The further above the 50 line that we are, right, this lets us know that the buyers are more in control because sellers are unable to take price lower, right? And it's actually a good thing if we get a shallow pullback because that lets us know that buyers are actually stronger at the moment. Okay. And we'll be looking, if we get a consolidation above and we fail to reach the 50, we'll be looking for that rejection of a low, right, and a hold above that area, right, and expect higher prices. Another alternative is that you draw a fib from this high, right, to this low once it's formed, right, and you simply measure the 50% of that level, right? You measure 50% of that swing, and once we trade above that area, okay, we know that now whoever is selling inside this region, right, anyone who's selling anywhere in here is currently losing money, and anyone buying anywhere in this area is currently making money at this point, right? And you'd be looking for that hold, and you'd be expecting a stop run above this high. And once we break out of that level, right, there's a possibility that we can get a volatility expansion higher, and that's what we're anticipating. Okay, so when it comes to fibs, that's literally all we should be looking for, and it's how I use fibs, and it's a more efficient way of using fibs rather than looking for a rejection of a specific area right inside the fib. This is simpler and it's more efficient, and it actually has an edge behind it, right? Because there's actually statistical significance behind these levels in the Fibonacci. Okay, now let's just go into price and have a look at the fib tool, right, and see how we can actually apply it to price and see how this actually works out. Okay, so we are here on Euro USD and we are currently on a 5-minute chart. Now you can do this on any time frame, right? It really doesn't matter. If I just zoom out, right, and take my fib tool, okay, and I just draw it from any swing point, swing high to swing low, right, what you'll notice is that we get our pullback, right, and we get that rejection, right, and you can see we have little consolidations in this area, right. Any of those consolidations could be entries for lower prices, and we are going to be targeting the low first of all. The second target is going to be the 50, and the third target is going to be the 100%. Okay, now what's important to note here is that once we get this move up, right, we see that rejection, we see that sharp rejection. Nowhere in this area do we see price consolidating. Okay, and that's very important. Okay, and you'll also know it lines up with a previous area of resistance. Okay, now it doesn't always have to, but that obviously can add to the confluence, right, at that area. Now, what you'll also notice is that if we just take a look at this area of price here, okay, if we just look at this move, right, you'll notice that we can also add a fib to that swing point because it is not time frame dependent. Okay, so if we just add a fib to that level, right, to that swing point rather, okay, what you'll notice is that after we get our strong impulse up, we retrace to the 50, right, and we respect it. Okay, you see price rejecting the 50. Then we retrace back to the 50 and we respect it. And you can see in this area here, we get a consolidation, right? Little triangle that forms above the 50% of this swing high and this swing low, right? If I just draw an imaginary 50% line in that area, you'll notice we get that consolidation in this area, right? And that's a clue, right, that we can expect to take out this high, right? So an entry somewhere in this area, whatever entry trigger you're looking for, or however you enter a consolidation, right? Because all this basically is, it's basically a flag at a higher price, right? It's just a holding pattern, right? Whatever your strategy is to enter on that, whether it's at the break, right? Whether it's at the low, right? So whether you enter at a break and you keep your stop at the low, or you wait for that rejection of a previous low, right? Or you simply enter near the low, right? And keep a wider stop, right? Whatever your personal entry mechanism is, right? You're going to apply that to this area, right? Once you're above the 50, you see price consolidating, right? Let me just remove the drawing tool so you can see that clearly, right? Draw that 50% properly, right? So that's about the 50%, right? And we can actually zoom into that area and have a look, right? You can see we have a basic consolidation, right? And then we break out and go higher, okay? And you're basically going to be targeting this level, right? But if we're already close to this level, right, you don't have to use it as a target. Depending on how low your entry is, by the time we break this level, you should have your stop to break even, okay? And once we've broken this level, we can expect price to continue running up because it's when price breaks out, whenever we have a pullback, right, and price breaks out, right, it's at that point we can expect price to continue moving lower, okay? So we can expect that in this case, right? And price reaches the 50, minus 50% and the 100% target perfectly. Okay, so let's continue looking at other examples. Right. Right, so now we can have a look at this impulsive move. Right, we draw a fib over it. Right, we get their pullback. Right, you'll notice that price reaches the 50. Right, and we do not hold above it. Okay, instead we reject. Right, and once we reject, what you'll notice is that if you measure a fib from this high to that little low, right, and draw a fib over it, this pulls back about to the 50, right, and you can see that weak rejection, and that's basically what you're looking for. Right after we get this larger rejection, what you want is to go on a lower time frame and look for that impulsive move down and that correction, right, and trade the continuation lower within that area, right, and that's where you'd basically be wanting to find the most ideal entries. And also if we take a look at this swing point, right, you will notice also that we have an impulsive move up, okay? We trade back towards the 50, right? With an ABC correction, right? And we reject the 50% once, and we trade below it a little bit and reject again, right? And this is basically what you're looking for, and you'll be looking to go long, and you'll be looking to target this high, the minus 50, and we reach the 100% perfectly, okay? All right, so we want it always above the 50. Nowhere do we want to see price trading below and consolidating in this area, right? So we can move on, right? And we can see when price trades the low, right? And I forgot to mention, okay, that if we just look at our targets, right, for that previous swing, okay, for this larger swing, you will notice that we actually met all three targets, okay? It's not always that you'll meet the target, but very often you will, right? And you'll find that the 100% extension will be a very large turning point, right? Now, once we reach the 100% and we meet that level, right, we see a very impulsive move up. We can literally draw our fib off that level, off that impulse, okay? And what you will notice, yet again, is that price retraces to the 50%, and nowhere do we hold below the 50%, and we get that rejection, right? We get that rejection, okay? And we then trade higher, okay? And we ultimately meet the first target. Well, the second target, this would be your first target, right? This will be your second target, and this will be the third target. And price overshoots that target, but ultimately, right, we reject around that zone, okay? And if we take a look at the larger swing, right, from this point to this point, right, you'll notice that price trades to the 50, right, and we reject very strongly, okay? And then we trade back to the 50 and we trade below this low, and we have a rejection of this low, okay? So we basically have an ABC, right? It's one of my favorite patterns, right? And we reject the low, and you'll be looking to enter on a lower time frame on a small little pullback somewhere in there, okay? And you'll be targeting the first high, right? And we don't reach the other targets, right? And nowhere in this area do we see price trade below and hold below the 50, right? If that happened, we are not looking for longs anymore, okay? Now, if we take a look at this swing point, right, we'll notice the same thing, right? We trade below the 50, right? And we reject the area, and we do not consolidate or hold below, right? And you'll be looking to target the high and further targets which we do not meet. Okay, so we only reached one target, okay? And we can draw a fib from the next swing point, right? We'll notice that it trades back to the 50. We get a rejection, we got a small consolidation and a move higher. Now we don't even reach target one, but this should be enough for you to at least get to break even, right? And from there, what happens is that we trade lower. Okay, so we can do one more day of this, right? And if you draw your fib from this swing point to the swing point, right, you'll notice that we get to the 50, just fell short of it, right? And we start to trade lower. And what you want to see is these areas rejecting. So you do want to see this rejection. Once you see price rejecting highs below the 50, that's a sign of sellers coming in below the 50 level, right? And you can start looking for sells, right, around these areas. If you're not so confident, right, you can draw another fib from this swing high to the swing low, okay? And once we trade below the 50 of this swing point, right? So as long as we are above this 50 of this swing high, right, and this swing low, let me just get my drawing tool. So we've drawn our fib from this swing high to this swing low, and as long as we're above it, we can assume that prices may go higher, right? We want to trade below this area, right? And we want price to start holding below this area, right? And we see that happening in this area. And once that happens, we know that we are most likely going to take out this low, right? And if we take out this low, there's a chance that we will end up having lower prices. Okay, right, and that's exactly what happens. So you want to be looking for your entry in a consolidation in this area, right? So basically, right, the point at which this swing point fails, right, this swing high to this swing low, if I make it thick enough, right, just to explain this point, right, the point at which this swing point fails, right, below the 50, right, is where you want to be looking for a trade, right, to target the low, right, in the grand scheme of things. Okay, right, okay, so if we keep it moving, okay, we draw our fib from the next swing high down to the next swing low, right, you'll notice that we reach the 50 area and we reject, okay, and we end up on lower prices, right? And you take the next swing point, draw it from swing high to swing low, right? So we take the next swing point, swing high to swing low. We see that we trade towards the 50. We do not consolidate above the 50. We reject the 50, right? And we trade lower, right? And you can see also, just like the other areas, right? These targets are being met, okay? And we can do the same, right? Swing high to swing low, we trade back to the 50 and we reject, right? And we trade lower. Now this one does not meet targets, the final target, target 3, but we meet targets 1 and 2. And we can look at the next swing point, right? And here we'll notice, right, price trades towards the 50, okay? And this is what we do not want to see, right? We do not want to see price consolidating in this area, okay? And here we see that price trades to the 50, we reject, we go back above the 50 and we start to consolidate. This is what we do not want to see, right? But then something interesting happens, right? Because at this point, buyers were somewhat in control, and then we trade below the 50 again, and sellers regain control. And you can see that consolidation below the 50, right? And then now that tells us that we can continue, right? The trend, the larger trend lower, okay? And we can expect lower prices, and that's indeed what happened. Okay, now that's how I use fibs, okay? And I hope you learned something from this video. If you have any questions, leave a comment below. I would appreciate it if you liked the video, shared the video, and subscribed. And if you want to communicate directly with me and ask whatever questions you want, you can feel free to join my Telegram group chat. The link is in the description below. It's completely free, and it's basically a discussion group. And I hope you enjoy this video. And until next time, safe trading.